mutual fund application form. Let's say you are hired by a bank, okay? You are now mutual fund sales rep. A new client comes in. What do? First things first, you need to be aware of 3 different forms. Form number 1 is KYC form. We are familiar with KYC. We know that KYC has different components like what? Like personal condition, financial condition, investment needs and objectives, risk profile, investment knowledge, and investment time horizon. These components comes in a form, and your client needs to complete this form. The next form is waiver of information. What's that? If a client refuses to provide any part of the minimum information required on the application, okay, a waiver should be obtained in a written form from the client. And then you need to refer that client to your branch compliance officer or branch manager for further assistance. It is really hard to deal with clients that don't want to provide even minimum required information. It's super hard to deal with them. The third form is special authorization agreement. What's that? It's for those clients who wants to place orders by fax or phone. So you must have a special authorization agreement signed by the client if the client intends to place the order via fax or phone. Awesome. So we know that we need 3 different forms when new client comes in. That client needs to complete KYC form, and we need to get a waiver of information and a special authorization agreement signed by the client. Are you going to get question from mutual fund application forms? You may be. Let's get to the type of question you might get at your final test from this topic. As part of the Know Your Client evaluation, assessing the suitability of investments falls under which component? Personal condition, B, financial condition, C, ability to tolerate risk, and D, investment time horizon. This is super hard question. All 4 options could be right, but the text says that financial condition. So option B is suitability of an investment falls under financial condition, because financial condition includes the income, the assets, the liabilities. So the mutual fund sales rep have an idea of the financial condition and can make the decision of the suitability. Okay, so the right answer is B. Feel free to read the white text on the right. Great, let's get to the next topic. Return versus time. Before starting this topic, remember, return has direct relationship with risk. Okay? If you if you expose your money, at high risk, okay, you want a higher return. Your risk and return, when your risk is high, you expect higher return. When your risk is low, you expect lower return. So remember, risk and return can use interchangeably. They have direct relationship with each other, okay? Now, we have a figure here. In the horizontal line, we have time, and in the vertical line, we have return on investment, okay? We have divided this figure into three different parts: short-term investments, medium-term investments, and long-term investments. So as I said earlier, if an investment is long-term, you expect higher return. If an investment is short-term, you expect lower return. Great. So, example of short-term investments are money market funds. Money market funds are those which have less than 1 year term. So your investment ends like in 1 year. The maximum is 1 year. So when you invest in money market funds, which is only 1 year, you should not expect that much return, okay? The good point about short-term investments, which one of them is money market funds, is that there are no risk involved with them, okay? No risk, but lower return. The primary goal of short-term investments like money market funds is maintaining purchasing power, okay? They want to, so we have inflation every year, okay? We need to beat that inflation in order to preserve our standard of living, our purchasing power. So that's why money market funds' goal is preserving that purchasing power. Let's get to medium-term investments. What are the examples of medium-term investments? Bonds, mortgage funds, and preferred dividend shares are examples of medium-term investments. As its name indicates, medium-term. So you have medium risk or low risk, and you expect medium return, okay? What's the primary goal of medium-term investments like bonds, mortgage funds, and preferred dividend shares? Maintaining purchasing power, and also, okay, they try to generate income. So bonds, when you buy bonds, that the issuer will give you interest income every, for example, 6 months or every 3 months or every year, okay? So the goal of medium-term investments are preserving or maintaining purchasing power plus getting some interest income from those investments. And finally, long-term investments. What are the examples? Equity growth funds are long-term investments. They have the time horizon is long, but the good point is you will get higher return. Remember, higher return associated with higher risk. Okay, there will be lots of ups and downs, But like finally, when the investment time horizon is long, when the time is long, the ups and downs won't affect that much, because you're gonna see your investment gonna see lots of ups and downs, but the trend is upward. Okay, your last your final return will be higher, and there is no guarantee in that, but it is something that usually happens with investments. What's the primary goal of long-term investments? Capital gains. Let's say you buy stock today at $10, okay? You're gonna sell that stock, you will sell that stock in 10 years. Let's say in 10 years, your stock's price is $300. Now, see that price difference? Your stock has been appreciated in value, so you will get capital gain. So the primary goal of long-term investments are getting capital gain. Awesome. What type of question you may get in your final test? Let's get to it. What is the correct order from lowest to highest risk for the following investments? What a great question. You will get exact same one on your final test. Trust me, believe me. Try to answer it yourself first, okay? A, treasury bills, provincial bonds, debentures, preferred shares, and common shares. B, debentures, treasury bills, provincial bonds, preferred shares, and common shares. C, treasury bills, preferred shares, provincial bonds, and common shares, and debentures. And D, provincial bonds, treasury bills, debentures, common shares, and preferred shares. We know that treasury bills is one type of market, money market funds. We have talked about money market, like different types of financial instruments or securities in chapter 2, remember? So treasury bills is part of that money market funds. So treasury bills will have the lowest risk and lowest return. And common shares are part of the equity securities and has the highest risk or highest return between these types of investment or instruments. Okay, so then the right answer is A. A starts with the lowest risk, like treasury bills, and ends with the highest one, which is common shares. You can go back to chapter 2 and read the financial instruments like topic in the slide, and it will basically give you an idea of what are different types of securities and instruments. By the way, we will have a full description of each type of securities in future chapters. Awesome. Let's get to the next slide. Common terms in finance and investment. Let's learn 3 different terms: discretionary income, personal net worth, and risk profile. We're going to use these 3 terms a lot, especially in upcoming chapters. So let's learn them, okay? What's discretionary income? Discretionary income or cash flow, these are same, is amount of money coming in from all sources minus amount of money going out to pay bills and other debts. So discretionary income is cash flow, and we know cash flow is amount of money comes in minus amount of money goes out. The second term, personal net worth. What's personal net worth? Personal net worth is total assets minus total liabilities. Okay? Let's get into details. We have different types of assets. To be exact, 3 types of assets. Asset type number 1, readily marketable assets. Like what? Like cash, investments, life insurance, mortgage. These are liquid. We can access to them right away. Okay? So readily marketable assets is asset type number 1. Asset type number 2, non-liquid assets. Like what? Like pensions, like RRSP, like annuities, like tax shelter. These takes time. These are not, you can't just access them right away today. Okay? So these are called non-liquid assets. Asset type number 3, others. We have tagged them as others. So like what? Like home, car, art, jewelry, recreational vehicle, and these types of assets. So we now know different types of assets. We also have different types of liabilities. What types are there? Personal debt. Like what? Like mortgage, like creditors, or like credit cards, like loans. These are personal debt. Second type of liabilities are business debt. So like what? Like business loan. You have business and you loan for your business. This is also your liability. Okay. And the third type of liabilities are contingent loan. Like what? You're a great person. You've guaranteed for someone else. Okay. Like if somebody goes to bank and has low profile, so low income, and bank trusts them, like wouldn't trust them, they will ask for a guarantor. Okay. And you will guarantee that loan, that transaction. Now you are liable. This is the contingent loan type of liability. Awesome. So personal net worth equals total assets minus total liabilities. And we do have different types of assets and different types of liabilities. Term number 3, risk profile. You're gonna see risk profile like 200 times in future. Risk profile. What's risk profile? The risk profile is the lower of 2 terms. Risk tolerance, which shows willingness to accept risk. Okay? And risk capacity, which shows the ability to endure risk. So, risk, we do have a term risk profile. This risk profile has 2 subterms. Risk profile is the lower of these 2 subterms, which is risk tolerance, willingness to take risk, and risk capacity, ability to take risk. So each of them is, if both are low, the risk profile of your client is low. If one of them is low, again, your risk profile of your client is low. if both are high, so the client has willingness to take risk and his financial condition allows him to take risks, so capacity to take risk is high. So if both terms are high, then your client's risk profile is high. Great. This was a very good slide. What type of question you may get? Let's get to it. Which of the following formulas is correct? A, net worth equals assets plus liabilities. B, liabilities equals net worth minus assets. C, assets equals net worth plus liabilities. And D, net worth equals liabilities minus assets. As we said, personal net worth equals total assets, whatever you have, minus total liabilities, whatever you need to give back. Okay? So it just played with different factors, okay? So the right answer is assets equals net worth plus liabilities. So option 3 is correct. You may say, like, this is a really easy question, I won't get this type of question, but with all due respect, you're wrong. You may get this type of question. So try to totally understand, like deeply understand what net worth is. Great, let's get to the next topic. Life cycle hypothesis. The life cycle says that individuals' consumption and savings patterns, okay, vary over their lifetime and influenced by income, by age, by preferences, marital statuses. So life cycle hypothesis gives you, as a mutual fund sales rep, an idea of like the situation of your client. Okay, clients, like all clients, have in common situations, depending on their age. We do have 5 different hypotheses, which depends on the age. Okay. Number 1, early earning years. This group includes the people who has age of less than 30 years. Okay. These group, like this group, early earning years, has short-term goals. Okay. And they have high risk profile because they have a low age. They're not old. They are super young. So they have ability to take risks and their willingness to take risk is high. So they have high risk profile and their typical asset allocation. So when, let's say they have $100, okay, they will invest 80%. So $80 on equity funds, equity which was the riskiest funds, okay? And they will invest 10% on bond funds, so $10 of that $100 in medium risk investment, and 10% on money market funds, which is a short-term investment. Okay, so let's say your client is in his early earning years. Okay, the typical asset allocation, if he or she has $100 on his hand, the typical asset allocation will be $80 in equity funds, $10 in bond funds, and $10 in money market funds. Why? Because your client has high risk profile. He's young. He can invest in risky securities. Great. Second group is called family commitment years. The age criteria is 25 to 35. Okay? People in this group will save for their child education. So this group members are typically married and they have like one child maybe or two children. They try to save for their child education. This group has the primary characteristics of this group is lack of liquidity. They don't have money on their hand. Okay? Lack of liquidity. They have mortgages, children's cost, education. They don't have money. So lack of liquidity is the primary characteristics of family commitment years group. Okay? This group, members of this group need life insurance. So life insurance is required for this group. Okay? So, and let's get to the asset allocation. Typical asset allocation for this group is 50% on equity funds. So it has dropped from 80 of early earning years to 50 because they can tolerate less risk right now. Okay, this group can tolerate less risk. So 50% on equity funds, 20% on bond funds, and 30% on money market funds, which has the lowest risk and the lowest return. Let's get to the third group, mature earning years. Age criteria, 30 years to 50 years old. They have high risk profile. They are mature. So they are typically a couple who both have income. So the household income is high in this group. Okay. They have a high risk profile, two professional income family. The main focus is tax minimization. So they're earning a lot, but they're paying more taxes. They need to shelter, they need to minimize that tax. So their primary goal is minimizing tax. And let's get to their typical asset allocation. 40% on equity growth funds. Equity growth funds is one type of equity funds, like the riskiest type of equity funds. So they will invest 40% on equity growth funds, then 30% on just typical normal equity funds, 20% on bond funds, and 10% on money market funds. So they are interested even in more in a riskier investment than the first group, which also had high risk profile. Let's get to the fourth group, nearing retirement years. Age criteria, 45 to 55. This is self-explanatory. They are nearing to their retirement. Okay, it's their high earning years. Makes sense. When you're near your retirement, your earnings are the highest. Okay, because you have improved in your job, so you are earning more. So they are this group is in their high earning years, but they have low risk profile because they are near to their retirement. They don't want to risk their money and put in the risky investments. Okay. Let's get to the typical asset allocation for this group. So 30% on equity funds, 40% on bond funds, and 30% on money market funds. So it's kind of balanced for this group. They don't want to risk and put all their money in equity funds, but they are also avoid to put all their money in money market funds. They take the medium. They are more interested in the medium term investments like bonds. And finally, the last group, retired years. Let's get to the characteristics of this group. The age is greater than 55 years old. They also have low risk profile because they have been retired. They can't risk their money, okay? Because they are not working now. They need to survive, so they can't risk and put all the money in the risky investments. Let's get to the typical asset allocation. Just 10% on equity funds, 20% on bond funds, and as you may guess, 70% on money market funds, which money market funds which are the lowest, has the lowest risk and also lowest return. This makes sense because they have been retired. They need to serve. They are not working now. They do have a specific amount of money. They need to pick the investment wisely. And the wise approach is putting in money market funds. Awesome. Will you get question from this topic? Not only one. I feel like you will get 2 questions just only from this topic. So if you haven't get it seriously, please do it now. Okay? You need to memorize. Some groups make sense, but some does not. So, for example, the primary characteristics of family commitment years was lack of liquidity. You need to remember this. Okay? Or the primary goal of mature earning years is minimizing tax. You need to memorize this. You need to memorize. Or for the family commitment years, they need life insurance. Okay, you need to memorize these primary characteristics because you will definitely get questions from this topic. As I said, not only one, but 2 questions. Let's get to the type of questions or question you may get. According to the life cycle hypothesis, what characteristic describes a client in the family commitment years? A, plan for both short-term and medium-term goals. B, interested in savings but financial goals are short-term. C, lack of liquidity. D, risk averse. As I mentioned, remember those primary characteristics of each group. So lack of liquidity and the need for life insurance are 2 characteristics of second group, which is family commitment years. So the right answer is C. And that group, second group, is interested in medium-term investments, medium-term goals like education of their child, okay? Let's get to the next topic. Planning pyramid. What's planning pyramid is? The planning pyramid is a strategic framework, for organizing and prioritizing goals and objectives. Okay? It shows what should your priority be in your life. We're talking from the financial perspective of your life. Okay, this pyramid shows the priorities. We can categorize this pyramid into 3 groups. Group number 1 is security. Group number 2 is independence. And group number 3 is investments. Let's get to the group number 1, security. What does security mean? It means, it says, this pyramid says, you as a person, you need to secure yourself first before investing in anything, before thinking about independency. You need to secure yourself. What are those? Those are insurance and will. Okay, you need to get life insurance. So this is the foundation of your financial goal or financial objective in life. Making yourself secure, yourself and family. So you need to have will and you need to have insurance. The second group and the next priority is being independent. So independence is the name of this group. Now try to have house, try to have RRSP account, emergency fund. Okay? We didn't invest it yet. We haven't thought about the investments yet. The first group was making yourself secure by having insurance and will. The second priority is having house, RRSP, and emergency fund, so you will feel independence. And now we enter to the third group, which are investments. That third group has also 4 subcomponents or subgroups, which are conservative investments, moderate investments, aggressive investments, and very aggressive investments. Conservative investments include fixed income securities and preferred shares and GIC. Okay. Then we get into moderate investments, which are stocks and mutual funds. Then we get to aggressive investments, which include tax shelters, commodities, and derivatives. And finally, we get into very aggressive investments. Okay? Like what? Like art, IPO, OTC, real estates, like precious metals, gold, silvers. These are under very aggressive investments. So the whole point of this pyramid is that, like, it helps you to have an idea of your financial priority in your life. Okay, it says you need to have your house first. Okay, and then go buy, I don't know, art, which is very aggressive investments. It says you need to have your insurance first and then invest in commodities. Okay? When you go higher in the pyramid, it gets less priority in your financial life or financial perspective in life. Great. Will you get question from this this topic? You may get. I personally don't think so, but you may get. But what type of question you may get? Let's get to it. Which of the following options presents the accurate sequence of investments, beginning with a conservative option and progressing towards a very aggressive option? A. Fixed income, stocks, precious metals, and commodities. B. Stocks, GIC, precious metal, and commodity. C. Fixed income, stocks, commodities, and precious metal. And D. Precious metal, stocks, commodities, and art. Before we get to the answer, if you get a question from this pyramid, which I personally don't think so, okay? If you get one, you will get this type of question. The right answer is C, and for the reason, just check that pyramid, okay? Pyramid starts from when you go up on the pyramid, the priority get lower. Awesome. Let's get to the challenge. I have prepared a challenge for you. The question that I am sure you will get on your final test. Let's get to it. Challenge designed just for you. Let's get to it. At what stage of the life cycle is there typically a higher inclination to buy life insurance? A, early earning years. B, mature earning years. C, nearing retirement. D, family commitment years. You will get this type of question on your final test. So remember to memorize all those characteristics of 5 life cycle groups. Okay? We know that 2 primary characteristics of family commitment years are lack of liquidity and the need for life insurance. So the right answer is D. And yes, we finished chapter 4. You are doing awesome. Keep up the great work. I will see you in chapter 5. So take care of yourself.
What's IFC? IFC stands for Investment Funds in Canada. It's the very first certification you need if you're aiming for a banking or financial advisor role in Canada. Think of it as your gateway into the banking world, setting a solid foundation for your career. How to register for this certification exam? It's simple. Head over to csi.ca, find the IFC page, click on the Enroll tab, pay the fee of $475 plus tax, and you're all set. You'll have up to 1 year to take your exam. What to read for the exam? Once you register, CSI will provide you the IFC book, which has 18 chapters and a total of 765 pages. If you commit to studying 4 to 6 hours a day, you will be ready in about 2 months. It's a big book, but with focus, you've got this. What's the exam format? The exam is flexible. You can take in person, at the specific times of course, or online any day, anytime. It's a 3-hour exam with 100 questions. You'll need 60% to pass. But if you fail, don't panic. You've got 3 attempts. How are the questions distributed? Here's how the questions break down by chapter. Please take a screenshot, it's a lot to read. I'll wait for your screenshot. Now, how to make sure you're ready for the exam. MOCKEXAM.ca is your secret weapon. You'll find 6 full sets of practice tests totaling 600 questions that match the real exam in both format and structure. It's your final stop before exam day. Let's get the job done.